Hey, it's Mark here, and today I want to talk about startup fundamentals. And this is important for investors as well as entrepreneurs. These are the three core areas that you want to look at if you're an investor. You want to make sure that the entrepreneur is handling this, and of course, if you're an entrepreneur, you want to handle this. So, for any business, the first thing you need to do is define your market niche. And so, we start with the overall market, and then we narrow down to what's accessible. Where can we begin to get traction? So if you're an investor, you're looking at an entrepreneur's pitch deck, you want to see how they've sliced up that market. It's not enough to say, well, there's 1 billion people on the planet and we just want to get 0.5% of that. That's not good enough. You really need to have given it some thought. So let's take the vegan launch business model. We've done our research, and there's $69 trillion of public stock market investment overall. Based on our calculations of the number of vegans in the world, we feel there's $2 trillion of vegan stock market investing. But we can't get that 2 trillion. We're not trying, at least not today, maybe somewhere off in the future. So when we look at all the vegans who are invested in the stock market and vegan-minded people, we're looking at a very small niche that's going to be highly risk tolerant and creative investors, people that are very passionate about investing in the vegan economy. And so that becomes a very, very small fragment of the total number of vegan investors in the world, as well as a relatively small number of the total assets. Fortunately, a tiny percentage of $2 trillion is still quite a lot, and we can do a lot of good with that. And based on that calculation, that was part of our rationale for going into the market. Now, the next key factor for success is a valid transaction model, something that's at least testable. So that's why it's important that you can define your very first niche that you can go in and test with, because there's just not a lot of investors out there who are willing to fund really long-term research projects. There are a handful, and you'll find that especially in the medical research arena, people can often raise millions and millions of dollars for what's really nothing but a science project. But for most of us, we need to get some traction pretty early and proof of concept. So you want to look at the transaction model. Does it make sense? How easy is it to test that? And can it be done on a budget? And that leads to the last factor. So a strong entrepreneur is going to have what I call a capital plan. And a capital plan, it's more than just a budget. If you look at how companies grow, you have some money, you spend that money to achieve a goal. On achieving that goal, the valuation of your company goes up, the value goes up. For example, let's say you've got a good idea. For most investors, a good idea is not worth too much. But if you can get some proof of concept, if you can prove that some people are willing to pay money for your good idea, all of a sudden the whole business takes on a whole new life, and it rationalizes investment, and it increases the value of the company. So basically, if you're an investor, you want to look and see if the entrepreneur has mapped out milestones in a logical way that are designed to continually increase the valuation of the company. So now, as an entrepreneur, this is of course vital, because if you're just self-funding and doing it your own way, you can do it however you want. But if you're trying to bring in investors' money to help you fulfill your business vision, it's vital that you are focused on what investors need, and investors need return on investment. And so in other videos, we're discussing what creates a strong return on investment in early stage businesses. How does that happen? But right now, the main point is that focus on planning out the capital you're going to raise and how that's going to increase the valuation of your company and subsequent raises and so on, so that the investor has a sense of where this is going from the point of view as an investor. And a lot of the entrepreneurs that come to me, they just can't raise money because they're trying to sell the investor on their product. And this is a real pitfall. This is also a red flag to the investor that the entrepreneur hasn't done their homework about how to raise capital. The investor is buying an investment product. Your customers are buying your product and services. So the entrepreneur needs to make that distinction, and the investor will know that if the entrepreneur is selling them an investment and not trying to sell them their widget, then that entrepreneur has got a fighting chance of returning some value.